There's a brand new US tax law that could save real estate investors thousands of dollars this year, but almost nobody's talking about it. It quietly brought back 100% bonus depreciation, and if you own rental properties, this could be your chance to supercharge your tax savings. Today, we're breaking it all down. What's in the bill, how to use it, and how to avoid missing out. Hey there, I'm Chad Carson. You can also call me Coach Carson, and in this show, I teach you how to use real estate investing to achieve financial freedom so you can spend your time doing more of what matters. Now, real quick before we dive in, yes, this tax bill is Donald Trump's one big, beautiful bill. And I get that some of you love this politically and some of you are disgusted. But I decided to talk about this bill because whether you love Trump, dislike him, or don't care at all, there are real legal tax savings opportunities in this bill. So today we're going to break it down as objectively as possible and help you figure out what, if anything, you can do to take advantage of. And to help me do that, I brought on tax experts and CPAs Amanda Hahn and Matthew McFarland. Let's get started. So I'm hoping you can help me unpack this. And my first question for you is this a net positive? Is this bill that's passed, is this a positive for real estate investors? And if so, can you give kind of like the upper highlights of how this might be a benefit for real estate investors?
Yeah, for sure. I mean, it's not a surprise, right? The new tax bill favors real estate investors and business owners. But I think what a lot of people don't know is that the One Big Beautiful Bill actually is pretty all-encompassing. Obviously we'll dig into kind of all the real estate tax benefits, but it has a lot of benefits just for regular folks too, from people who, just own a primary home, or people who live in high taxing states, to people who, even lower mid-income people who make tips, or, people who just work overtime and family. So there's a lot to unpack here. And I think that's why it's, called the One Big Beautiful Bill, because it's sort of all encompassing.
I think they didn't put it through ChatGPT to come up with a better name, but that's my guess.
Marketing channel. Come on now.
Yeah, right.
Yeah, exactly. Yeah, I think that there is so much in it. Sometimes you hear, if there is a bill passed in Congress these days, whatever your feelings are, left or right, we're getting into like the real estate side of it, but there's so much packed into every single bill that it's really hard for like a regular person to understand, like, all right, how does this apply to us? I think what I like to do, let's start with the complete real estate investor perspective. I want to get into some of the personal stuff too, because I think that's really interesting. But what would you say are the top things that are the most beneficial that have changed in this bill or that have been extended in this bill that a real estate investor should know about?
I mean, first and foremost, at the top, I think the biggest one that's going to impact a lot of our clients is the kind of reinstating what's called bonus depreciation. So, for the people who don't know, in the tax world, we have depreciation. It's kind of this paper write-off the IRS gives us every year for our rental properties, our equipment and whatnot, where you buy something, you get to write off the cost of that over a certain period of time. Now, they had bonus depreciation for years, where it just means certain assets you can write off right away instead of writing it off over time. That was going away, cutting back, phasing out, whatever you want to call it, where it was getting ready to go away at the end of next year. But now they brought it back to 100% bonus depreciation. So for all those rental property investors who are buying furniture, appliances, doing landscaping improvements for their properties, those are all kinds of things that can be written off basically 100% right away. So you're spending $50,000 to furnish a short-term rental. That's a $50,000 expense right now instead of maybe $20,000 a year, right? So I think, or $10,000 a year. So I think it's going to be a big impact on at least our client base in terms of rental property owners.
And I will say, because the bonus depreciation rules were dwindling down, like Matt had said. So previous to changing the changes in the One Big Beautiful Bill, bonus depreciation was set at 40% for 2025. And so by bringing it back up to 100%, you're effectively more than doubling what the tax benefit would have been. So for those of you who are investors who, were anticipating accelerated depreciation, that's a pretty significant change to what you can expect to owe in taxes for 2025.
All that sounds really good. It sounds like it's a positive move. I want to make this real for people who just heard all this tax lingo and depreciation that kind of went right over their head. And maybe can you give me an example? Like, let's say I buy a duplex and it's a $300,000 property. Like, how can you make some like tangible comparisons? Like, all right, if you didn't have bonus depreciation and you just did regular depreciation, here's what it might look like. And then if you did bonus depreciation, here's how much more you could save in taxes. I'm just curious, can you translate a write-off to the actual like tax bill we pay?
Sure. So like if we're talking about a 300,000, let's just say it's 350, right? Your purchase price and 300,000 is the building because we can only depreciate the building. So under the old rule, high level, maybe we're writing off, let's say $45,000 of first year depreciation. If you do accelerate depreciation, but with 100% bonus depreciation, maybe you're looking at 90,000 of a write-off or even more. And what is the actual tax savings? Well, that will depend on your personal tax rate. So if you're someone in a higher tax bracket, let's say 37%, then Matt did the math for me. 90,000 times 37% is your tax savings.
Somewhere around $35,000.
Okay.
Public math is the best when you have to like do it in your head in front of a crowd, right?
Yes, I could do your calculator real quick. It's pretty significant. One thing I will tell people too is if you're an investor and you are buying new property, you're intending on utilizing this tax benefit, don't wait until next April to get a refund back. Make some moves now. If you're working a W-2 job, change your withholdings now so you get some more money in your pocket. If you're paying estimated quarterlies, reduce those quarterlies because it's really about keeping more of our money, month after month and reinvesting it rather than giving the IRS an interest-free loan.
Yeah, that's a really good point because what I'm hearing you say, both with the example you had and what you're just talking about there, is that this is a lot about timing, I would guess, right? Because the depreciation, regular depreciation, as I've done over the years, like 27 and a half years for a residential property. Is that the typical? So you divide that 300,000 over 27 and a half years, you get a certain number. What you are talking about though with accelerated depreciation is you might be able to push a lot of that to the front, and so you're getting these huge tax savings right now. And there's a time value of that. You could take that money. So if you made an extra $20,000 in savings from your taxes, that's money you could go spend on down payment or investing in a short-term rental or something. That's like real tangible money. The sooner you get it, the more you can invest it. That seems like that's kind of the bottom line.
Yeah, I mean, we'll say, accelerated depreciation is not for everyone. So sometimes people will listen to a podcast and they go out and start taking accelerated depreciation. So, in fact, before you do that or decide to do that, first thing is to meet with your tax advisor, right? Because we want to know, does accelerated depreciation make sense for you? And the answer is going to differ from person to person. At the heart of it, what we want to know is, are you able to actually benefit or minimize your current tax bill by doing so? Because if you're not, let's say you have high income, you work full time and, you're not using like real estate professional or the short-term rental loophole, then maybe the strategy is let's take regular depreciation and then we'll wait until next year or 2 years down the road to then take accelerated depreciation. So it's not a one size fits all. So I just want to make sure people understand, as good as it sounds, it doesn't mean you should go out and do it right away.
And that brings me to like a follow-up question. So like, I think first step is everybody needs to know there's this concept of bonus depreciation and getting more tax savings sooner that's available. You should know about that. You should talk to your tax advisor about that. That's part one. But part two is that your tax advisor is going to talk to you about your situation. And one of those questions they're going to ask is, are you a regular real estate investor who's not a professional, who has a W-2 job, or you make money somewhere else? Or are you a real estate professional, or are you a short-term rental person? So can you talk to me? The reason that's important, you just said, is because of this concept of passive losses. And I know I want to unpack this idea, kind of like depreciation, because some people hear that and they don't really understand why that's relevant. Can you explain why that matters, what passive losses are, and how that's related to all this?
Yeah, it's definitely an important topic in the tax world. Kind of comes down to looking at like if you're investing in rental properties, even a business, right? Like somebody invests in Keystone CPA and God forbid we lost money. Well, if they weren't involved in the business and they got a share of a loss on a K1, if they're not actively involved in the business, they can't use that loss because it's quote unquote passive to them. So passive losses can only offset passive income. Now, rental properties by default are generally considered passive activities. So basically the IRS is trying to limit people from deducting rental property losses against all their other income unless certain exceptions apply. You were kind of alluding to like real estate professionals, short-term rentals. Those are a few of the exceptions, but it's definitely important that just because you're investing in a business or rental property, if it loses money on paper, and if we're talking about losing money because of depreciation, not necessarily losing money, right? Then it's going to matter of can you use that against W-2 and other income. It's going to depend on some of those exceptions.
Yeah, I mean, the default rule is, if you're someone who makes under 100,000 or less, usually if you're investing in long-term rentals, you can use up to $25,000 of rental losses against W-2 and other income. So that's pretty simple, straightforward. You don't have to do anything. But if your income is over $150,000, usually that means your rental losses are passive, like Matt said. So they only offset passive income and not your W-2 income. The loophole around that is if you or your spouse is a real estate professional. So when you're a real estate professional, then even for higher income earners, you could potentially use rental losses against W-2 income to reduce your overall taxes.
What's your thoughts on this idea of a real estate professional? And I'll tell you my context and my background. Like for many years, I have not been a real estate professional, even though I own a lot of properties. And the main reason being I never even tried to meet some of the minimum rules. Like I'm traveling in Europe, I'm living in Spain. Like my whole goal was to have a passive real estate investing business. And when I flipped houses early in my career, I was a real estate professional. And because of that, I could take advantage of a lot more of these passive losses. What's your thought on, for most real estate investors, how many of them actually are or should be real estate professionals, and how many are just like, look, that's a lost cause. Don't even go there.
I don't know. It's tough because a lot of our clients are either already pretty active in real estate or they have goals to really grow a portfolio. So I think, the percentage of people who are actually real estate professionals already or trying to achieve real estate professional status is probably pretty high, at least in terms of clients we work with. And it makes a very significant difference. Let's say we're talking about a married couple, and let's say one spouse makes $500,000 of income, and the other spouse is either a stay-at-home or someone who's making, let's say, $40,000 of income, right? If neither person is real estate professional, they will continue to pay taxes on all of that W-2 income, and the real estate the real estate loss or deductions will basically offset rental income for tax purposes. Now, if we switch the facts and say, let's say that the spouse that makes $30,000 of income quits their job and decides to do real estate and become a real estate professional, well, now we can use the rental losses to offset the $500,000 of income. And when you run the numbers, there are often times where by one spouse quitting their job, they actually net more money in their pocket simply because of tax savings by being a real estate professional. So you just have to kind of look at the numbers.
So you can basically build your whole strategy around it, especially like I've seen a lot of my mom and dad actually did that. My mom was a dentist. My dad was a full-time real estate investor. And, somebody makes $500,000 a year, you could sometimes get that much in losses, or at least a big chunk of that. And so maybe even take your tax bill, what was $100,000 or $200,000 a year in taxes, down to really, really low, right? Is that kind of what we're talking about here?
Yeah, exactly. So it's like, hey, if I worked and I made 40,000, or I stop working and I save 100,000 in tax, right? So you come out net ahead.
Can you explain? I know this is a bigger topic, but like, what are the broad stroke things, the basic things that somebody has to do to meet that threshold of being a real estate professional?
Yeah, so I think for real estate professional, when we're talking about real estate, keep in mind this would be people who are investing in long-term rentals, anything besides, any rental properties besides short-term rentals, basically. The 30,000 foot level, someone has to spend, there's three rules. They have to spend at least 750 hours a year in real estate activities. They have to spend more time in real estate than any other job or, business that they're spending hours working on. And then the third one is they have to basically meet one of the material participation requirements for their long-term rentals, which just basically means that they are involved in the day-to-day operations of dealing with their property. So opposite example, this came up years ago, and I think in a court case, like somebody, retired person in his 60s, had like 50 rental properties, collecting checks, looking at financials, not really doing a lot because it's kind of, just set and forget it type of rental properties. And I challenged the IRS. The IRS said, no, you're not a real estate because you're not doing anything. You're just sitting back collecting a check. So it doesn't matter how many properties you have. It's a matter of, are you spending the right hours and doing enough to be involved in your properties?
Makes sense. It needs to be your main gig. You need to meet that certain number of hours threshold, and you actually need to be materially participating, actually doing something, not just signing a couple checks here and there.
Right.
Yeah.
And it's so important, I think, there are people who say, oh, this is all great. And I'll just kind of say, I'm a real estate professional. But when we talk about real estate tax benefits, it's always super significant. We're not like saving $1,000. You're saving like 10,000 or 50,000 or 100,000. So it's really important that if you're trying to use this strategy, you actually do the right things to earn those hours and document them. Because it's super painful if you're later audited and you can't actually prove, what you've actually said you've done.
And I think it's also for the listeners' benefit, because I think there's a lot of misconception. Someone's probably listening out there. Real estate professional doesn't mean that you are involved in the real estate industry. You're a real estate broker, an agent. That doesn't make you a real estate professional for tax. This is purely a tax designation, right? So you definitely got to meet those rules to document your stuff, so to protect yourself, like Amanda said.
Got it. So this isn't just a checklist you fill out at the end of the year to do your taxes. This is something you build your entire strategy around of your lifestyle, your business. Therefore, you can get these benefits. And so, yeah, I think, it's something I've personally not looked at for a long time, mainly because I'm that second person you explained, Matt. I'm the one who's like, I want to work 2 hours a week on my real estate.
Right.
Great, So, but I think if they want to benefit from bonus depreciation and some of these really the best of tax strategies that are out there, this is a nugget, right?
Well, and I think that's where it comes into. It depends on the profile, right? So if you're somebody that's kind of pure investor mode, where all I'm getting is K1s from a lot of different investments I do, being a real estate professional may not matter because you can use losses to offset income from those situations, right? But you're working W-2, you got a business. Maybe we've got clients who are just retired and they're looking to move money from pre-tax retirement to Roth tax-free environment. That might be an ideal time to kind of utilize real estate losses as a real estate professional to offset the income from the conversion. So it all definitely comes down to the profile and what their goals are, what they're trying to accomplish.
All right. There's one other situation that would be relevant to a lot of listeners. One is the real estate professional, so they can take advantage of this bonus depreciation. The other is short-term rentals. We have a lot of short-term rental folks in here. Can you unpack that specific loophole and how that's relevant to all this?
Yeah, the reason that sometimes people wonder, like, why is it called a loophole?
I know, bad word. But
I think it was CPAs that couldn't come up with a more creative term.
Yeah,
I don't know.
Maybe that was us.
Maybe that was us.
We were one of the first people who started talking about it.
But pre-chat GPT.
So the reason that we call it a loophole is because it is different than the traditional rule of passive losses that we just talked about, right? So when you invest in long-term rentals, you have to be a real estate professional. One of the requirements is more time than your job, which, indirectly means you got to quit your job and do real estate full time, right? But if you invest in short-term rentals, Airbnbs, Verbals, any rental where the average guest stay is 7 days or less, then those long-term rental rules no longer apply. So in other words, you don't have to be a real estate professional. You don't have to quit your job. You can keep working in your job or your career or your business. And real estate could be a side hustle and potentially use rental losses from the short terms to offset your W-2 and other income. So again, that's what we call it a loophole, because you don't actually have to be a real estate professional. There are still, of course, requirements that you have to meet in order to use the benefit.
Yeah, and so for short-term operators, it really comes down to can you meet material participation requirements? So they kind of the IRS almost looks at like similar to you investing in a business and determining if that business is active or passive. Same thing for short-term rentals. It's can you meet one of the material participation requirements? There's 7 of them that people can meet, but really 3 of them apply to 99% of the people out there. So those are the ones we talk about. The first one is, did you spend at least 500 hours during the year working on your short-term rentals? And again, this is involved doing a lot of the boots on the ground type of thing, right? Day-to-day stuff, dealing with tenants, staging properties. That's kind of the 500 hours is a gold standard because it doesn't, you don't care about how much time other people are spending. You can, if you are married or have a spouse, you can combine the hours between you and your spouse to get to the 500 hours, which is cool. But if you can't get to 500 hours for some reason, maybe you buy a property later in the year, right? You close in October, put it in service in November, you're not going to get 500 hours. Then the next tier down is, did you spend at least 100 hours during the year? And it's more time than any other single person spent on your short-term rental. So you have 130, you look around and a general contractor spent 110, and that's the most, you're good to go. And then if you can't meet that test for some reason, the next test is add up all of your time spent on your short-term rentals, as long as it's more than all the time combined from anyone else who spent time on your properties, then you can also meet the test. So you have one of those three different options to meet. And it's, again, the benefit, if you can meet it, then we can strategically create losses on paper from our short-term rentals. Then you can use those losses to offset all other income on your tax return.
Super powerful, because back to your example, the person who had $500,000 a year in W-2 income, if they weren't a real estate professional, if they had a short-term rental or two or three, this is now unlocking some of those that offset of that they can actually save taxes on their W-2 income, whereas they couldn't before.
Yeah, what I love about the short-term rental is that it works for virtually anyone. It's people just starting out in their career who don't have a lot of income, all the way up to like very high income W-2 people, right? People with like stock options or executives. We have clients who are athletes, social media influencers, even celebrities. Because again, it doesn't you don't have to like put a halt on your career. You can continue down that path, and as long as you have enough hours in the short-term rentals, then you're kind of combining the best of both worlds of better cash flow oftentimes and also massive tax savings. It's interesting because a lot of times when we have new clients come in, they'll say, oh, I hate taxes, I'm really bad at it. But once they see the benefit and the power of what tax planning can actually do, especially if you're investing in real estate, if you're not considering the tax benefits, then that's a big chunk of investment opportunity and wealth building. I always say like the tax part really helps you to supercharge your road to growing your investment, right? In that example even you gave earlier, save on the tax and use that as a down payment. It's like the favorite strategy.
There's some other topics I want to dig into. So bonus depreciation was the first one, but there's another one that I've benefited a lot from over the last few years, which is the qualified business income deductions. And I think people talk even less about this one, but it's really made a difference in my own tax return. So I was wondering if you could unpack what that is and why the new bill is relevant to this topic as well.
Yeah, so qualified business income, some people might have heard of it as QBI. It was a brand new thing that came out actually when Trump was previously in office back at the end of 2017. And basically just people who have an active business, a qualified business of some kind, they can get basically 20% of their net profit to be tax-free in certain circumstances. So could be real estate agent. We've got online marketer. We had an online marketer who was making $1 million a year and only paying tax on $800,000 because he was able to get 20% of it to be tax-free. So pretty powerful in the right situations. The benefit of the One Big Beautiful Bill is that it basically made that permanent and extended it. So there was talk that it was kind of going to sunset, go away, but under the new bill, they've made that 20% tax-free income permanent going forward. I mean, obviously pending, a new Congress or administration or whatnot, right? But
yeah, I mean, real estate wise, property, realtor income, property management. If you're syndication income, fix and flip,
wholesale,
fix and flip wholesale. A lot of those are qualified business income. I will say though, I'm happy to hear that you said you've benefited from that quite a bit. When we do tax planning with clients, one of the first things we do is review a previous year's tax return. Qualified business income deduction is still an item that's missed more frequently than not. Years ago we used to say, it's new, right? It's new. The CPA didn't really look into it yet, but now it's like years later, we still see that missed. If you're in and also applies to rental income as well. So if you're in real estate, and how do you verify? Well, on the first page of your 1040 tax return, there's a line called qualified business income deduction. Take a look and just see if there's a number there, so that'll kind of give you an idea if you're utilizing it.
So this was a little bit broader topic. So if you have a landscaping business, if you're, you have your own, medical, I don't know if medical professionals qualify, but, different, if you're selling different stuff, you need to check into it, but also rent. So if you have an LLC that owns 10 rental properties and you have a business, so that you're saying that's also under the umbrella of this QBI.
Yeah. Yep. Those are all qualified business income. And that's true regardless of whether you have an LLC. So even if you own rentals in your personal name, you have taxable income, potentially up to 20% of that income could be tax-free.
Got it.
They do pick on medical professionals and accountants and lawyers for some reason, that they limit our ability to benefit from it. But
Yeah. You can still do
the rest
it.
of you, we can still do it. We just don't get the same benefits, but that's fine.
There's limits.
I think there were too many Congress people who were attorneys and medical professionals and CPAs.
I don't know. They were trying to get at somebody. Yeah.
Who knows? Nobody's feeling bad for the CPAs and attorneys and medical professionals, are they? Well, so I guess I want to give it just an open question. So we've talked about bonus depreciation and really dug into that. That's a huge one. Qualified business income. People need to put that on the checklist. Talk to your tax advisor, or talk to Amanda and Matt if you don't have one. Are there other provisions in the bill that you think are interesting, both from a business standpoint, but also just personal standpoint, that people should be looking into, talking to their tax advisors about, and just have on their horizon?
Yeah, I think before we move to the personal side, the other thing kind of alongside the qualified business income deduction that we see missed somewhat frequently when we review tax returns, and also is sort of part of the One Big Beautiful Bill, is the pass-through entity tax break. So that basically, again, came out during Trump's first run in office. And that for the first time allowed businesses to pay for state income taxes of the owners. And by doing so, turning that personal expense into a business deduction. So that, again, that came out previously, and the One Big Beautiful Bill didn't necessarily change it, but it sort of retained the benefit that was previously provided. So very welcomed. I mean, especially if you're someone who has a business and have high state income taxes, it's almost a no-brainer that, if allowed, to have the business pay for that state income tax and turn it into a write-off. We have clients who hey, their state income tax is $30,000, $40,000, $50,000. Previously, you can't write it off, but with a pass-through entity, because the business pays, now it's a business deduction. So another really great one to make sure you're taking advantage of, if applicable.
Got that on my checklist now. I'll be asking that one. That's good.
Yeah, I think on the individual side of things, a couple of things that jump out to us is they did, why that PTE, that pass through anything, is important is because they, back in 2017, they started limiting individuals' ability to deduct their state and local income tax and their property taxes. They basically put a cap at $10,000. Now, with the One Big Beautiful Bill, they've raised that to $40,000, which is good. It's important. It's going to help a lot of people, maybe not people in high tax states like New York and California, but that's where, if those business owners can have their businesses paying the state taxes, it alleviates a lot of that concern of that. But I think that's going to be the state and local tax going from 10 to 40 is going to be big for a lot of people.
Yeah, I mean, it's huge. It's basically applicable to homeowners. If you own a primary home, you used to be able to deduct only up to $10,000, and that includes your personal state income tax. So now we've basically 4x'd that deduction amount, and really impactful for people who live in high taxing states, like Matt said, California, New York, Hawaii, just to name a few. So now we can, up to $40,000 is the deduction against an individual. And this is for, just anyone, W-2 people who own businesses. It's just a personal deduction.
That's pretty, middle of the road. If you're in California and New York and those states, anybody who has property taxes in those states are pretty high, and you add in state income taxes as well. It'd be really easy to hit $10,000. So yeah, that's going to apply to a lot of people. I do have a general question. We're talking about a lot of different deductions. And one of the things I remember reading about was that the standard deduction was actually raised. And for people who don't know what that means, is you can either choose to itemize all your deductions and make a big list of them, or you can just say, all right, forget all that. I'm just going to take the standard deduction and not itemize it at all. Do some of these benefits, do you have to itemize in order to get these benefits? Or are there some where you could do the standard deduction and also get some of the benefits?
It's kind of can both, right? So that state and local income tax is part of your itemized deductions. That would be something you have to itemize. The car loan interest, I believe, is regardless of whether you itemize or not. There's a few other ones that you can take standard deduction and still claim.
What's really interesting is, I think, what we've seen, because of the previous limitation, right? Like home property tax and state income tax, we're limited to 10,000. A lot more people were taking the standard deduction because we're so limited. Yeah. But now with the bump of even just the state and local deduction, I think more people might benefit from taking itemized deductions. And keep in mind that the itemized also includes medical expenses, that are out of pocket, charitable donations. So we might, see more people take advantage of that rather than just the standard deductions.
So what else? Well, I know there's a whole laundry list of things in there. Are there any others that stand out to you that real estate investors should know about?
I think the ones that are most interesting probably for, some people out there is that they wrote in the law new provisions to people who receive tips or overtime. They can get up to basically $25,000 of tip income to be tax-free or $25,000 of overtime pay to be tax-free. There are some income thresholds and phase-outs that kick in and slight variances if you're married or not, or, things like that. But that's pretty cool because they haven't had that before. So, somebody who works in a, hospitality industry, restaurant industry, gets tips as a primary source of income. I mean, think about it. They could, exclude $25,000 of their pay from being taxable income. That could be pretty substantial.
Yeah. And what's interesting too is, like Matt said, some of these new benefits, like with anything in the tax world, it comes with income limitations. So the more income you make, you start getting phased out of child tax credit and, the card interest deduction. And so that's where we see, proactive tax planning could come a long way. So maybe you're naturally someone who has very high income and you were not going to get any of these tax benefits or credits, but you have a spouse who became a real estate professional, or you became a real estate professional, or you're using the short-term rental loophole. And now with cost segregation, you're bringing your taxable income down from 400,000 to 200,000. Well, guess what? Not only did you save taxes on that 200,000, but now you're also eligible for tax credits that you were not going to get before. Now you can write off other personal things that you were not going to be able to write off before. So that's kind of the power, kind of the compounding power of when you plan and you reduce total income. Now you're getting even more benefits because now you're considered low income, right, for tax purposes.
Right. Yeah, I've had a CPA that I've paid every year since I've been in business for 22 years, and to me, it's one of the most obvious ROIs, return on investments, you have, because you guys obviously are on that side of the table, but it's so many things that I've missed that I would not have known. Like even the things we talked about today, like I hope the takeaway is people are making a list of things saying, I need to talk to my tax advisor about this so that they can implement it for me, because there's a lot of planning. Like you can do these things, but as we talked about earlier with a real estate professional, if you don't build your entire business around the strategy, it's not something you can just like fill in April or after you file your extension and say, oh, now I'm just going to get the tax break. Like you actually have to like think about it and plan ahead of time and have a strategy. So 100%, I'm a big fan of that.
We don't expect people to become CPAs, right? But as long as you can be armed with enough knowledge to have that intelligent conversation where you're asking the right questions, it's not, hey, am I a real estate professional? It's, hey, how can this be advantageous to me, or is this something we can take advantage of? Get the thought process moving so you're having that back and forth conversation instead of just a conversation where it's yes or no and move on from there, right?
Yeah, now you can just plug all your questions into ChatGPT and say, make a list of questions I want to ask Amanda and Matt when I talk to them next Monday, right?
And that brings up a really interesting point, because what we see a lot is, investors who educate themselves, right? So they're listening to, this podcast, they watch YouTube videos, and they end up with a list of questions, which is good. But one thing to watch out for when you're doing tax planning with your tax advisor or your CPA, it really should be more conversational. It really should be them asking you questions. So I'd want to know, like, Chad, what are you planning on doing this year? How much income do you expect to make? What kind of deals are we doing? What's our flip profit? Are you going to partner with anyone? And it's your answers to those questions that allow your CPA to come up with the strategies. Right. So yes, it's okay to ask them a list of questions, but it's more powerful when they are asking you the question. It's kind of like going to a doctor, right? You got your questions for them, but they're asking you very specific questions to help diagnose your problem and hopefully help to cure, resolve the pain, whatever.
All right. So I think, is there anything else you could think of? I know we've covered a long list of things and there's other things in the bill, but is there anything we left out that you feel like we should mention before we end up?
One thing that's not necessarily real, in the real estate context, one of the strategies we talk to people a lot about is income shifting. So the concept of if you have kids who are older, it could help out in your real estate, pay them to teach them work ethics, but also the money you pay them could potentially be a write-off for you, tax-free to them, and basically getting overall tax savings for the family. And the other benefit of doing that is then that money that they earn could be used to fund retirement accounts, right? Now, because before One Big Beautiful Bill, in order to fund retirement accounts, you have to have income for these kids. But one of the new changes under the One Big Beautiful Bill is now they have what they call the Trump account, which allows parents to fund up to, I believe, $5,000 per child per year into these accounts if they're under age 18. And that works kind of similar to a Roth IRA, where you use after-tax money to fund, but the money in that Trump account can grow tax-free. So something to consider for those of you who, have kids, you want to help them to grow a bucket of money tax-free. It's almost a no-brainer, right?
And the difference with that and the Roth IRA is with the Roth IRA, they have to have earned income. This one, they don't have to have earned income. So this kids don't necessarily have to be working yet. And you can still fund these. It's kind of setting up your kids for future financial success, for lack of a better term, right?
Yeah. Out of all the things I read on the bill, that was the one that actually jumped out to me the most. I sent it to a couple of friends. I'm like, you should look into this. They had just had a baby, this year. And so I think that one's really interesting. And there's one other provision, and maybe you could explain it, where maybe the federal government actually matches $1,000 for certain people born at certain times.
So the way I understand it, for any kids that are born in 2025 to 2028, the government will basically put $1,000 in there to kind of seed money for lack of a better term, right? To kind of get the account going, and then you can still fund your, $5,000 as I understand it.
Yeah. So it's great. Free money, have more kids.
Yeah. There we go.
Right.
Yeah.
There we go.
But even if I have a 14 and a 12-year-old, we can still open those kind of accounts. So even though it's just the people who had 25 to 28 or the seed money.
Yeah, the newborns will get that $1,000, but the rest of them, you could put in there for your 12 and 14-year-old for sure.
And the way I look at it is, it's pretty restricted though in terms of what that account could invest in. So I've already asked the question, can we do a self-directed?
I know. That's where my head was going right now. Yes.
Yeah, real estate notes, and under current wording of the language is that it's pretty conservative, no leverage. It's going to be traditional stocks, bonds, and mutual funds. But if you're someone who just has money in the stock market, well, why not move it to this Trump account for your kids? Because you're taking it from a taxable environment to a tax-free environment, right? So almost a no-brainer.
Yeah, something I actually just talked to my kids this morning about that. One of them asked, do we have some money in I told them you have some money in an index fund, and you actually own Amazon and you own Google, and so when we're just everyday conversations about stuff, I'm like, hey, no, you actually own a piece of that. So I think this is a kind of a cool opportunity for parents to be able to do that same thing of education while also having the compounding. Instead, we just have a custodial account right now. Instead, we could have it in a tax-free account. They could learn about taxes in addition to learning about the companies. I think that'd be pretty cool. We'll have the advanced level finance kids, when they get into college. That's the goal, right?
Yes, for sure.
Amanda, Matt, this has been really helpful. I hope people walk away here with a checklist of things that they didn't know before. I want to give you a chance to talk about yourselves, what you have going on. Obviously, you're tax advisors to a lot of my friends, people I know in the real estate space. You've written 2 amazing books with bigger pockets, which I think everybody should own if you want to cover any of these topics. But I would love you to just let people know how they can hang out with you, connect with you after they listen to this.
Yeah, we have a passion in educating people about, the fact that you can control how much taxes you make. How much you can control how much taxes you pay. And so to that extent, we have a lot of content. I'm typically found on Instagram as Amanda Han CPA, same handle for our YouTube channel. And
our website is KeystoneCPA.com. We've got a lot of free resources on there. We do speak frequently throughout the year at different events. So we've got a couple of those things coming up. So I'd tell people to check out our website for if they're interested in checking out a real estate conference and seeing us in person for sure.
All right. Well, so good to have you. Thank you for being here, and I will see you soon.
Thanks, Chad.
Thanks, Chad.
This episode was all about saving money on taxes, but we didn't talk at all about what happens when you sell a rental property, because you can pay a surprisingly large amount of taxes. So in my next video, I share exactly how much tax I paid when I sold a rental property, and I also share a free tool that you can use to estimate your own taxes if you're going to sell a rental property of your own. If you're watching on YouTube, you can click on the thumbnail above me here, or you can click on the link in the podcast or the YouTube description below. Thanks so much for watching. I'll see you in the next episode.